Hey, everybody, welcome back to the next episode of the Multifamily Investing Podcast with Charles Dobbins, your host, the multifamily attorney. And I'm very happy to have on today a guy that interviewed me on his podcast back when when podcasting was still in its infancy. And I've been taken to podcasting kicking and screaming because I'm the kind of guy that didn't think the internet was going to take off. But Joe Fairless is the guy who has, oh my gosh, Joe, how many podcasts you have out there now? How many shows?
I just happened to look. Normally I wouldn't know, but I just happened to look. 1,743 is today.
Unbelievable. Now listen, I love doing these things. They're a blast, but you've got done over 1,000. You were doing like at least one a day, or was that your pace?
Yep. World's longest running daily real estate investing podcast. Done one a day for the last 1,743 days.
That's fantastic. Good for you. But let me give you a background because Joe Fairless, he's a full-time real estate investor that started buying apartments back in 2013 after the crash. And now controls over almost $500 million worth of real estate and about over 4,200 units. He has personally raised over $100 million. Now, that's what we're going to be focusing on today, his book that he wrote. I want to hear all about it. Prior to that, he was a youngest vice president at an award-winning advertising agency in New York City. And he's his best real estate investing advice ever podcast. He's interviewed such guests as Barbara Corcoran, Robert Kiyosaki, Emmett Smith, and Tony Hawk and Charles Dobbins. I don't know why I have to edit your bio to include that, but I had to. Now, he's authored several books. Now, here he's two books, Best Real Estate Investing Advice Ever, Volumes 1 and 2. But the one that we're going to talk about today is his book on best ever apartment syndication book. And that gives you a proven step-by-step system for completing the first apartment syndication deal. So that is what, and I'm going to tell you something, Joe. It seems like every podcast I've done, the last 5 podcasts have all talked about syndication and making those things happen. If we can systematize a way, that's fantastic. He's on the board for junior achievement and received the honor of outstanding alumni at Texas Tech University. That's where people go to school and they can't get into Boston College. And you can learn more about Joe on his website, www.joefairless.com. Fairless, Fairless. And Joe, it's great to have you. And I know that let's kind of tell people kind of like how we reconnected here. I finally came to the world of podcasting, and I liked somebody gave me the name, Best Ever Multifamily. And I thought, geez, somebody came back, hey, that's really close to Joe Fairless. Says, yeah, but it's not exact, so I'm okay with it. And then you came back and just graciously said, hey, that's a little close. Can you change the name? I'm like, I'm not looking to pick any fights with anybody. If Joe wants me to change the name, I'm going to change the name. So, I made it a condition that you have to be on my podcast, and you graciously agreed to come on. So welcome. I'm back with you. Your first time with me on the podcast. Welcome, Joe. It's good to have you.
Yeah, looking forward to our conversation.
Good. Now, listen, one of the things you talk about this book that you wrote about syndication, I'm going to ask you, this is the thing about this podcast is, I'm going to ask you the good, the bad, and the ugly. And and the thing that is the most important thing is the fact that you talk about creating a system for syndication. Mm-hmm. And why don't you give us, your history with syndicating deals?
Yeah, sure. So I bought my first house in 2009, and it was in Dallas, Texas. I was living in New York City. I'm from Texas originally, and then I graduated from Texas Tech, who is having a phenomenal spring, by the way. You mentioned your Eagles, but I don't know if they've won the national championship in indoor and outdoor men's track this year, or made the national championship in basketball, or currently in the College World Series in Omaha. So how about that? You all are really smart cookies, though. I'll give you that.
I was just going to say, none of those things have anything to do with academics. But how'd you do that, Joe? How'd you do that? So.
Very true. Yeah, I was a solid C+ B- student at Texas Tech. So.
It's interesting. I was just watching the NCAA outdoor track and field on the channel. I guess Texas Tech was right up there. Oregon crapped out.
Mhm.
I'm trying to remember who the other big players were, but Texas Tech won, you say, huh?
Texas Tech won. That's right. Yeah,
Yeah.
we're killing it this spring.
Wow.
So I went there, and then
Can I just say that Bishop Girton's girls lacrosse are state champions here in New Hampshire? Uh,
congratulations to
yeah,
Bishop Girton. Go whatever their mascot is.
go Cardinals.
Go Cardinals. That's right.
Yeah,
At least they're not Cardinal. I can't get. I still don't know why Stanford says the Cardinal. I don't get that.
yeah, yeah.
Um, so I went to New York City after I graduated college and lived in New York City for 10 years. And then I started investing on the side um, as I made some money in advertising. First salary was $30,000, and then it grew from there. And so as I was keeping my living expenses relatively low for New York City, bought my first house 2009, and then bought another, then another, and then realized that it just wasn't for me because it wasn't scaling. I was making $200 a month
Yeah.
off my properties, and uh, today I'm actually selling the three homes. I sold the fourth a while ago, is the Ugly Duckling, and then I have three left. I'm just going to sell those and just invest in our deals.
What were you doing? You're like getting involved with someone else, or they would go down there and find the homes for you, or
Yeah, I never visited a house before I bought it.
yeah,
I had a real estate agent, and he would go look at the home. He would take pictures. He'd do a video walkthrough of the home that we were looking at, and then that gave me enough information to make an offer and buy it. And
and
then
this
the
was
inspection report I would just give to my dad, and then he would tell me, "Hey, this is good, this is bad, this is
yeah,
fixable, this is not. I can fix it. You need to hire someone."
yeah, yeah.
And that's how I got started on my first homes.
And that was 2009. So you were probably buying these homes pretty cheap too, right?
Bought my first house for $76,000 October of 2009, and I'm selling it now for, call it 180. It's not under contract or anything, but we're about to list it for about
Yeah.
180. And then the second house I bought for I don't know, like 86,000. The third one around 56,000, and all of them are worth about 175, 180.
And these are good, like nice, 3 bedroom.
Yeah, 3 or 4 bedrooms. So I had certain things I'd look for. One would be at least 3 bedrooms, ideally 4 bedrooms. Two would be as much of as much house on property and as little yard as possible. That way I maximize the tax benefits with depreciation.
Yeah.
Three is I just wanted a good rent ratio. So at least a 1.2. So take a look at, or take the purchase price, the rent, and then just divide it and at least have 1.2. And then I wanted something to be relatively move-in ready, so I didn't have to pump a lot of money into it. And at the time, I could pull that off in Dallas Fort Worth. I don't think people can at this moment in time, or at least not in decent areas.
Different world.
Yeah. So I decided to get out of that, and also get out of my full-time job in advertising because I wasn't digging it anymore. And
Well, where were you living in New York?
when I first moved to New York City, I lived in East Flatbush, Brooklyn.
Okay.
It is, at the time, it was the busiest police precinct in all the five. There were statistically, it was a hot place for crime.
Wow, because I have 2 kids that live in the same apartment in Harlem. So
Okay.
they move out of the $1 million house in Duxbury, Mass, into Harlem. I mean, this is a perfect example of how I've trained my kids well on location.
Right.
Yeah.
Right. Yeah. Yeah. It was rough. I don't know what it's like now. This is
Let me tell you something, Joe. It's probably beautiful.
probably is.
Oh
Yeah.
my
The
gosh.
apartment building I was living in is probably luxury units right now, but
Yeah.
it was tough at the time. There were literally in the newspaper the weekend I moved out, there were 10 separate shootings or stabbings within a mile radius of my apartment.
Wow.
Within one weekend, and it made the newspaper. So that was a little uncommon for the area, but you get an idea of the type of area that I was living in for a year. My mom visited me that year, and she was drawing a picture looking out my window. She was drawing a picture of what it looked like, and she told me later, like years later, the reason why she was doing that is because she wanted to capture the last apartment that I would ever live in, because she didn't think she'd ever see me alive again.
Oh my gosh. Oh my
Yeah,
gosh. Thanks, Mom.
yeah, it was tough.
Wow.
But whatever. Some people who are listening to this are like, dude, I've grew up in areas like that and lived there all my life. Screw you, buddy. Like, you spent a year there. So.
Yeah, but you know, Joe, we also have some people listening on the call right now who says, wow, your mother drew the picture? We have cameras that take pictures now.
Right. Yeah. Well, this was 2005, 2006. So I don't know if the camera phone was prevalent back
Isn't that
then.
amazing? How far
Yeah.
we've come. Okay, so you're in Cincinnati now.
Mhm.
How'd you end up there? And let me guess, have anything to do with a woman?
My wife is from here. Yeah. So we live here.
They'll do it to you every time, Joe.
Yes. Yep. So we live here. I really like Cincinnati. I actually really, really like Cincinnati, having lived here, but there's no way I would ever have picked this city out of many cities to choose from. But I'm glad that we did. Her family lives here, and so we live here. And there's a part.
Have you met Pat Gary yet?
I have not.
Attorney Pat Gary.
What type of attorney is he?
Well, he's going to be a criminal. He can be a criminal defense attorney.
Okay. So I'm glad I have not met Pat Gary.
Yes.
I have not been to jail yet ever.
He's my college roommate. So if you need one, I recommend Pat Gary, and not for real estate. No.
Yeah. Well, I hopefully will never meet him in my life. That's
on a social occasion.
Yeah, fair enough. Yeah. I do like talking to attorneys. One of my good friends is a federal. Well, he's a good family friend. I haven't talked to him in a while, but he's a federal defense attorney, and he argued in front of the Supreme Court and won a case. And he is just a ball of entertainment.
Oh, I was going to say, you can get the best stories from those guys.
Oh my gosh. Yep. Yeah. You want him at your dinner party.
Yeah.
I mean, he can tell a story and it's all true, but you don't think it could possibly be true.
And you think, how does that other half live? Like, how can it possibly be? I'll tell you, going down on a Monday morning to the arraignment court and just looking around thinking like it's like a scene out of the Star Wars bar scene. And like, where do these people come from? Oh.
Well, I mean, I really enjoy being called for jury duty.
Do you?
I do. It's only happened once, and fortunately it was in New York City, so it was pretty entertaining. But then I got dismissed because it was a tenant landlord dispute.
Oh, yeah.
So they're like, you can't be in here for this. But I was very disappointed because I grew up watching Law and Order, and my family would watch that, and I've read almost all the John Grisham books except for the ones where he went off brief and he started doing like Christmas stuff and things like
exactly
stick to the law. But
that's the difference between you and me, Joe. You grew up with Law and Order. I grew up with Judge Wapner.
Yeah. I don't even know who Judge Wapner is.
I know you've been sworn in. I have your testimony. You claim to be Joe Fairless, real estate investor. I mean, that's how the shows would always start. So
okay,
yeah,
that's pretty cool.
Yeah. Judge Wapner. Jeez. I tell you, and it's interesting you say you like talking to lawyers because most even lawyers don't like talking to other lawyers. So
I really respect the way a lawyer thinks.
Yeah.
In college I took the practice LSAT, and for a hot month I thought I wanted to be an attorney, but even. And I didn't end up not wanting to do it. But even during that month of wanting to do it, and probably maybe 6 months leading up to where I was thinking about it, I was taking practice LSATs. And I swear, just by taking those practice exams, I got smarter. And I learned a way of thinking very logically and if then, and I just really appreciate how good attorneys think and how they process information.
And I got to tell you, that's why I love the multifamily business, is because it is all so logical. And then you apply the law degree on top of it and how to think through any problems you have. It is so incredibly logical. And that's why, this it's like I was made to do multifamily real estate transactional law and help people through transactions because it's just like you said, it's so logical. It just makes
Yeah.
sense. It's
Yep.
beautiful. It's beautiful. Okay, so you end up in Cincinnati. You got the deals, and you finally decide, and that's where you and I connected for the first time. You were in Cincinnati, and you were just getting started. Doing the multifamily. You contacted me, you had me on your podcast, and boy, you've done amazing things since then, Joe. So bravo to you, bravo to you. And just so people know, well, doesn't Joe do coaching too? Yeah, he does, but it's a big swamp. We all, there's plenty of good information out there. So I have no problem recommending Joe and his training to people and what have you. So let's talk about your first multifamily deal.
Yeah. So it was in Cincinnati and is the only deal that I've lost money on. Ended up paying back investors out of my pocket plus 14%
Wow.
annualized return. And now they're investors for life and learned some lessons on that, obviously, many lessons.
Okay, let's talk about those. So where did you go off the rails? Right from the very beginning?
I didn't even know what rails were at the time. So, I mean, I'd say a couple lessons learned. One is have the right. Well, one is know what you're good at. Know what's needed to be successful in this business, and know where in those categories you can bring value, and where in those categories would you be a liability should you focus on them. And so with multifamily syndication, you've got basically three categories. You got to have the deal, you got to have the money, and you got to be able to execute. And on the first deal, I did all three. I was looking for deals. I was bringing the capital, and I was a team of one. I had a property management company that was not. I don't think they were top notch, to put it as nicely as I can. But I was the one doing asset management. And so what I realized is that through that process, hey, I need to make sure that I know that I can bring capital through the relationships that I have, but I need to bring on a team member who can, or a partner who has the deep knowledge and expertise in the asset management or the execution part. And then ideally, they also help find deals, or we both partner up on finding deals. And so I met my business partner, Frank, and we formed Ashcroft Capital. And he's a civil engineer major since we've talked colleges, might as well say what college he went to. He went to Bucknell Bison. So civil engineer major, and he got his MBA at UCLA. And when I met him, he had 8 or so years experience working for a multifamily firm that overseeing $500 million worth of assets across the country, some student housing and some not. And so he brought, at the time, almost a decade plus worth of execution experience, as well as relationships with brokers. Whereas I was coming, I worked at an advertising agency. My major was advertising, and I didn't have those relationships, nor did I have that execution skill set. And so he brought the two categories of expertise that I did not have, where when I chose to apply those in the deal, it was a liability and not an asset. Because as you know, I mean, we're swimming with sharks when we do these deals. It is a very linear process in that we know what the steps are, but we're dealing with people who are at the top of their game for the most part, and you're competing against people at the top of their game. So you've got to have your A team as well. Yeah. And I learned that, hey, I need to bring on a partner whose skills complemented mine and who I complement their skill set. So now we have a beautiful partnership. And since we formed Ashcroft, we're doing very well for our investors, and we've continued to grow from there.
Excellent. So, but specifically, give me one specific mistake.
Didn't know what a pro forma was.
Wow.
On the first deal. Or I did know what a pro forma was. I shouldn't say that, but I didn't realize that I needed to have it in place prior to the prior to due diligence. And in fact, I had hired a consultant, one who I certainly would not recommend, and I won't call him out, but I hired a consultant at the time, and one of my investors was asking me, "Hey, this deal looks okay, but I'm just going to bring on one of my friends who's in the business, and he just wants to have a conference call." I was like, "Oh, okay." And so I asked my consultant to join the call with me, and my investor's friend asked the question, "Well, where's your pro forma?" And my consultant said, "Well, we don't have a pro forma until after due diligence because I don't know." He gave some reason. I'm shaking my head. Yeah, that's right.
Yeah.
Duh. Why would I have? And so that's the level of ignorance I had starting out, and so there was a steep learning curve for me. So that's one specific example. Another specific example is right after closing, we had to make a large insurance payment, and I hadn't budgeted for that. Another specific example is I raised enough money to close on the deal, but I was planning on paying for improvements out of the cash flow from the property. That did not happen. Another specific, I keep going. Another specific example is I didn't recognize the difference between occupancy and economic occupancy.
Oh, wow. Yeah.
So the owner told me, "Well, we're at 98% occupancy, and if you want, Joe, I can get to 100% before you close." I'm thinking, "Yes, please. Yeah, thank you. That's nice of you." Well, turns out what he was doing is he got to 100% occupancy, but then he was doing a deal with those residents who moved in where he would get upfront payments from them for months 1 and 2, and then he'd give them like months 3 and 4 and 5 for free or something wacky like that. It's a little bit of a blur at this point, but
wow. Why did this guy hate you so much, Joe?
Well, I think ultimately it's my fault because ultimately it's up to me and my team to make sure that we have the proper provisions in place and checks and balances in place to not allow that to happen. And now, obviously, we don't. But on my first deal, there were all sorts of things that I messed up on, and unfortunately,
you live to see another day.
And now you learn from it and you continue to grow, and here we are.
Excellent. So let's get to your book, because I really want to talk to you about this. I want to hear how you've grown into this syndication expert, and I'm gonna pick you a little clean on some of the facts and see how you do certain things. So give us an overview of how you handle syndication.
Oh, well, that's kind of like asking me, what do I think about life?
Yep. Well, maybe okay. So here's my question is, when now you're out there, probably at the stage you are right now, people are bringing you deals. And so you're now picking and choosing which deals you want to get into. So when you find a deal that you think, okay, I want to take this one to the closing table, what does it have to look like in your eyes?
It is built between 1980 and 2005, at least 200 units, value add component to it. Most likely we're going to be renovating the interiors and increasing the rents. We'll be under the market leader, but we'll be second or third on the rent comps. It'll be in a major MSA that we're already focused on.
Wow. So for those of you that just heard and are wondering what Joe just did, he has his elevator speech down pat. He knows exactly what type of properties he's looking for, and that's what you get to in this business is you find out, like, because and I'm sure Joe, you'll agree with me that it's just owning and operating property. You find out what types of properties are the easiest and most cost effective and profitable to own and operate, and that's what you just go with.
Mm-hmm.
Now,
Yeah.
yeah, I mean, let me just ask you. I mean, Cincinnati. Are you doing a lot of deals in Cincinnati, or where are you doing most of your deals now?
We're doing 0 deals in Cincinnati.
Yeah.
We have 4 markets that we're focused on. Dallas, Fort Worth. I'm grouping that as one. Tampa, Orlando, and Jacksonville. We have the bio that we gave you isn't updated, I guess. So we've got about 5,800 units right now, and we have one property, 250 units in Houston, but we're not actively looking at Houston. And we have the rest in Dallas, Fort Worth. We're closing on a deal in Tampa next week. We do not have any properties currently in Jacksonville or in Orlando, but we did recently get awarded one in Orlando, so we would close on one next 90 days.
All right. Now, are you staying away from Houston because it's a pre-review area, or?
We're staying away from Houston because, well, let me rephrase. We're not staying away from Houston. We've just identified that we have 4 markets that we like the most.
Okay.
And so those 4 markets, they have a bunch of fundamentals that we like. I'm not opposed to Houston. We currently own one property there, and we recently sold one in Houston. But it's just not at the top of our list.
Okay. All right. So you find this deal, it meets your criteria. What's your next step?
Well,
like in other words, do you get involved in the due diligence and the underwriting, or do you kind of let the person that brought you the deal handle that, and you're out there looking for the money for it?
Oh, okay. So I think there's a misunderstanding. So we don't JV with people who bring us deals. Yeah. So we just work directly with brokers.
Okay. So this is you and your partner with Ashcroft.
Yeah. So we've got a firm. We're headquartered in New York City. I live in Cincinnati, but the crew's headquartered in New York City. The co-founder, Frank, he's in New York. We got an office there. Our director of acquisition, Scott Lebenhart, he came from an institutional background, and he is the front line for our acquisitions. So Scott is speaking and networking with brokers. Gotcha. They share opportunities with him. He then underwrites those. He reviews those deals and that underwriting with Frank. And then once he and Frank both like the deal, we make offers on those deals prior to getting into best and final round. If we get to that point, then they share that opportunity with me. I take a look at it, make sure that I'm good with it, and then we proceed in best and final round.
I get you. And let me tell you why I was under misimpression here. Is I had one of your students, Dan Hanford, on the show. Good guy, and it just made it sound as though he worked with you on his deals. That was the impression I got.
Yeah, he has partnered with us. He's brought equity as a minor GP on our deals, but people do attempt to bring deals to us, but to the best of my recollection, every deal, and we're closing on our 23rd property late next week. We're closing on our 23rd apartment community. All of those properties have come from brokers, to the best of my knowledge.
Gotcha. Okay. All right. So when does the syndication process begin for you in that cycle that you just described?
Once we have been awarded a deal, we start creating the investment package for investors. And then we'll have that done in about 5 business days. Okay. And then once that's completed, I will send it out. And then usually I'm sending it out the day that we sign on the purchase and sale agreement.
Okay. Wow. That's fast. So and then you subsequently do the due diligence after the P&S is signed, right?
Yeah, we do it. We've got over 5,000 units in Dallas, Fort Worth, and our property management company manages about 14,000. So, we're pretty familiar with the apartment communities there and the market and the sub-market. We do tours, obviously, before we purchase, and we know the areas. So, there's there's always something that comes up, but there's usually not anything significant because we know where we're buying and what we're buying prior to getting into the best and final.
And any problem you can fix with money.
Yeah.
And then, what the expenses should be on a particular property in that marketplace. So it makes the due diligence process a lot easier.
Mm-hmm.
Yep. So, all right. So how do you go out there and find the money?
Well, at this point, the top three sources of new investors, one is word of mouth referrals, two is my podcast or book, and three is Bigger Pockets.
Okay.
When about maybe about a year and a half ago, that wasn't in that order. Word of mouth referrals was number 3, and Bigger Pockets was number 1, and my podcast and book was number 2. Now the word of mouth referrals have increased. So, it's just about having a thought. I write about it in my book, having a thought leadership platform. And because the challenge that I had, and a lot of people who are listening might have when they're starting out, is there's a perception of who I was professionally with people who I knew, and it wasn't as a multifamily investor. And it shouldn't have been, because I was not a multifamily investor, but I was growing to be one. And the best way to do that is to interview other multifamily investors and other experts, and then be associated with them through those interviews when they share it out. Plus also learn along the way. One thing about the podcast, nobody in the world has interviewed more real estate investors than I have. Nobody in the world has done that. It's 1,700 and something real estate investors.
Yeah.
So I've learned a lot through that process. And also starting out, that helped me transition the perception of me as a advertising executive who was buying single family homes on the side, to now a multifamily investor who's interviewing all these other multifamily investors. And so that helped me build a relationship and change the perception that I have with investors. And when I get a new investor inquiry on my website or on Ashcroft Capital's website, and it says as the referral place, best ever podcast or best ever book, those conversations are so different from when they say online or Google as the referral, because when they say online and Google, we send them some information prior to the conversation, but then it's a much more qualifying me conversation versus qualifying or really just asking some specific questions that they are wondering about. And it's a different type of conversation. It's much it helps me be more efficient with my time with conversations to have the thought leadership platform, because people get to know me on their own time versus me having to say the same thing over and over again to many people.
Right. Okay. So your book, do you have a copy of it right now? You can hold up?
Well, you know what? I've got a Dell laptop, and I'm having to stack all my books because the Dell laptop, the webcam is at the very bottom. But yeah, so this was underneath the Dell laptop.
Okay, I was going to say, it's a good thing that Joe, it's a problem when Joe's 6'4", and he's had to write so many books.
Right.
The Dell thing. So hold it up for the audience so we can see. Actually, Nick, I see your face. Good. Excellent. Wow, that's a doozy, man.
Yeah, that's got
actually, I think you're also the first Texas
425 pages. What's this Texas Tech joke that's about to come?
You're gonna step all over my punchline. It's like you're the first Tech grad that's ever read a book.
There we go. What World Series were you in recently? I forget.
No, the World Series. Yeah, we were the last one. And,
okay.
Hey, Joe, listen. What are you doing tonight?
What am I doing tonight?
Yeah.
Actually, we have an investor call about our deal that we're buying in Dallas Fort Worth. So we're doing a recorded investor call this evening.
Oh, ask me what I'm doing.
What are you doing tonight?
I'm watching the 7th game of the Stanley Cup because my team's in it.
So you think I care about hockey? That's funny.
Yeah, I know, but like Columbus Blue Jackets or Black Jackets, what's that all about?
You did hear me earlier when I said I'm from Texas, right?
I know, I know,
Okay.
I know, I know.
Yeah,
So you got baseball,
football,
football.
football, and baseball, and now college basketball because Texas Tech's so good.
Okay, yeah. So, all right. Well, give us some samples of what a new person, what they're going to find out when they read your book about the syndication process. How do they set up a system for their business? What are your recommendations?
Um, well, I think depends on where you're at in your journey and what you're looking for. I mean, there's components to a deal. As I mentioned, the three components, finding a deal, getting the money and executing. But then also there's the fourth component, which is experience. You've got to have the right team, and to be on your side. And also you want to have alignment of interest with that team. And, one thing I talk about in the book, like I mentioned, it's 400 and some pages. But one thing is having alignment of interest with the team, because what I've realized is when I was starting out, I had some team members where there was no alignment of interest, and they were being compensated regardless of the success of the project. And as we grew, we were needing to do loans on properties that I couldn't qualify for. My business partner at the time couldn't qualify for. So we brought in a property management company on our first couple deals with Ashcroft, and we raised 75% of the equity, but we got 50% of the general partnership. And we did, we oversaw asset management. We did all those other things. So we got disproportionately lower equity in the deal for what we were bringing,
Right.
but that's because they had the balance sheet and the net worth.
Yeah.
And we did that for 3 or 4 deals, and totally fine with that because that's what we had to do. And we also had alignment interest with them because not only did they put their own money in the deal, but they raised some money. They raised like 25% of equity for the deal. So they had their own investors in the deal. And that made us feel really good, and also our investors really good. So when you're starting out and you're looking for ways to put deals together, then attract the right team members who have an alignment of interest. And I talk about in the book the different levels of alignment of interest.
Excellent. Cool. Because, man, I thought you were going to go down a particular road, and let me see if what happened with me in one of my first deals where we brought on partners. You talk about alignment of interest. We brought on these partners, and everybody had a task. But the problem was that in this partnership we created, everyone got the same amount of equity on day one. And then on day 2, if they didn't do a damn thing, they still had the same amount of equity that everybody else had. Mm-hmm. And they vested immediately. We couldn't get that equity back, and we had one person that their whole entire job was to raise the money, didn't raise a dime, but they got 20% of the partnership, right. And that was a huge mistake.
Yeah.
So, God, it's so good to hear that you made mistakes, Joe.
Yeah.
That's how you learn in this business. That's the only way to do it. So, well, man, thanks for being on my podcast. Thank you for changing the name of my podcast, and I appreciate that. I don't want to step on your toes. I like all the stuff that you've done. You've been a very good steward for the real estate education business, and I'm glad to see you doing incredibly well with the investing as well. So, folks, his name is Joe Fairless. He's you can find him on listen to his podcast. Follow him. He's got some great people on there, including myself. I think Joe. I think I might have been like episode number 13 or something.
Really?
Yeah, I was way back in the beginning. So I was a young man back then, Joe, and you were still in elementary school, I'm sure. So, but folks, Joe Fairless, Joe, thanks for joining us tonight. It was so great to see you again and hear your story.
All right, thanks a lot. I appreciate it.
Talk to you soon.